Hello investors and future investors, welcome to the channel. For today's video, I'm going to show you one stock, two strategies, and three ways you could win with this one stock. This video is going to show you how to use one stock in order to grow your small account portfolio exponentially over time. Now, if you're new to options trading or you're trying to use option trading in order to supplement your regular 9 to 5, then you so happen to stumble onto the right video. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make consistent income. For today's video, we're going to be going through one single stock, two option strategies, and I'm going to show you three ways to win just using the 1, 2, 3 method. Now, we're going to go ahead and we're going to get down and dirty with options by using our stock for today. And our stock for today is going to be none other than Trade Desk, ticker TTD. Okay, so here we are on the trade desk. And for those of you guys who don't know what this stock is basically an advertising company. It usually deals with just advertising and marketing, but that's not what is of peak interest to me right now. Let me go ahead and give you a simple breakdown of this stock by going to the Robinhood Advanced feature. And to get there, we're going to go to this advanced right to the top here. Let's go ahead and open that up. Now we're going to go out and we're going to choose our time frame. Let's go to the 1Y that depicts 1 year. Now what I want to bring you to your attention is the absolute diabolical price drop that this stock recently went through. Now the reason why this stock dropped so drastically is because it went through what's known as a stock trifactor. I'm going to explain the trifactor to you in just a second. But right now you could see the stock is currently trading at 56.55, which is trading way below the 200-day moving average. Now, the 200-day moving average is depicted by this blue line right here. And if you go to the end, you can see the 200-day moving average. The stock should be trading for around $105. Currently, it's trading at $56. Now, the reason why this stock has dropped so drastically, as I mentioned, was because of a trifactor. The first thing that happened to this stock is that the stock has a class action lawsuit being filed against the company. In addition to that, the number two factor that helped the stock drop drastically is because the company was supposed to release a new software, but they did not. And the third addition is that in addition to these two factors, this also happened in a bear market. So that sent the stock tumbling. Now, before I go any further, I always want to remind you guys to do yourself two favors. Favor number one, always make sure to do your own due diligence before investing. Favor number two, always make sure to have an exit strategy before entering any options contract. That being said, we're going to go further and we're going to go down to this right here, which is known as the Relative Strength Index or the RSI. RSI is a momentum indicator that's used to tell you whether the stock has been overbought or oversold. If we follow this line all the way to the end, you can see the RSI for this is around $34. So the two indicators I primarily use in order to gauge a stock before making an option decision to get into the stock is going to be my RSI down here and also my 200-day moving average. So the stock clearly shows that it's been oversold with RSI trading around $34. The stock also shows that based on the share price that it's been oversold again because it's trading way below the 200-day moving average. Now that I know that, this is what I'm going to do. So there you have it. That is one stock. Now let's go ahead. I'm going to show you the two option strategies I will be using with this stock. So let's go ahead to trade TTD options. Okay, so here we are on the TTD option chain. And what we're going to do now, we're going to go over to sell. We're going to go over to put. And now we're going to be doing bi-weeklies. Bi-weekly means every 2 weeks. We're going to be going with a strike date of April 4th. Now we're going to go ahead and we're going to choose a strike price. The strike price we're going to be choosing is going to be below our current share price of $56.55. And that strike price we're going to be choosing is going to be $54. As you can see, strike price to the top. With this $54 strike price, that gives us a 73% chance of this trade going in our favor. Now, because we're doing a sell option strategy, we're going to be receiving money. The money we're going to be receiving is $1.12. In real world, that's going to equal to $112. You simply multiply 1.12 by 100 shares, and that's going to give you $112. This option strategy is none other than the cash secured put. So there you have it. This is one option strategy that can be used based on where the stock is trading at right now in order for you to realize a big win. So your first win is going to be with the cash secured put. Once you do it, it's an income generating option strategy. So once you do it, you're going to be receiving money right away. The money you're going to be receiving is going to be $112. Now, you could continue to do this option strategy until you're assigned. Assignment simply means is that come expiration date of April 4th, if this share price goes anywhere below this strike price of $54, you're now forced to buy 100 shares of TTD at this strike price you chose, which is not a bad thing. The reason why it's not a bad thing is because now you're going to own 100 shares of a stock that I just showed you should be trading around $100. So there you go. That's the number one win. Let me go ahead now and we're going to get into the second strategy that you could use in order to maximize profitability on this stock. And for that, let's switch over now to buy. And then we're going to go to call. Now we're going to be going ahead. We're going to be choosing our strike date. For this one, we're going to go for our strike date. Let's go with March 20th, 2026, which gives us around 362 days to expiration. Now we're going to go ahead and we're going to choose our strike price again. This time, once again, we're going to choose our strike price below the current share price. And I will be going with the strike price of, let's go with the $50 strike price. With the $50 strike price, I need you guys to remember two very important details. Detail number one is going to be your break-even price. Your break-even price is going to be around $67. The next detail I want you to pay close attention to is going to be the delta. The delta is going to be 0.71. Now, with the $50 strike price and a 0.7 delta, you're going to have to pay because now we switched over the strategy to now a buying strategy. So now you're going to have to pay. The amount you're going to have to pay is going to be $17.30, which once again is going to be $1,730 in the real world. Let's go ahead. Let's click on it. This is known as a long call or a leaps option strategy. Now that you have this leaps option strategy, you're going to use it to make consistent income. And this is how you do that. Let's go over now to sell. Let's go to call. And we're going to be choosing a strike date. This time, the strike date we're going to be using is going to be monthly. So we're going to go to April 17th, which gives us 25 days to expiration. Remember, the first strategy we used, we did bi-weeklies. The second one we used, we did a year out. And now we're going to be doing monthlies. So now with the monthlies, what we're going to be doing is how we're going to choose our strike price above the current share price. Remember, do not confuse these option strategies. The first two, we choose our strike price below the share price. With this one, we're going to be choosing our strike price above the current share price. And we will be going, let's go ahead and go up. We will be going with the 67.5 strike price, and that gives us a 92% chance of profitability. But remember, with a 92% chance of profitability, that means there's also an 8% chance that this trade is going to go against you. Now, once again, for this option strategy, we're selling once again, we're going to be receiving some kind of money. The money we're going to be receiving is going to be 0.31 or $31. So this option strategy of buying a leaps option and then go ahead and selling consistent covered calls is known as the PMCC or poor man's covered call. So there you go. One stock, trade desk, two strategies, the cash secured put or the PMCC. Now, I'm going to go ahead and show you the three ways in which you could win with this one stock. So I did show you the first way, which is with the cash secured put, where you continuously keep selling options in order to generate income. And if the trade does go against you, then you're going to be assigned the shares. Once you assign the shares, you still win because now you own the shares at a much cheaper value, which is way lower than what I just showed you, which is the average cost, where the stock should actually be trading. Now, with this option strategy, I'm going to show you the second way you're going to win. And the second way is going to be by getting consistent premium. On a monthly basis, you could stand to get around $31 in option premium. Now, I know what you're thinking. $31 is not that much, but I am telling you right now, you're absolutely wrong. Now, if you remember, you did pick up your leaps option that cost you $1,730, and now you're using it to make $31 on a monthly basis. If you were to divide your $31 by your $1,730, you should be getting a 1.7 return. A 1.7 return monthly is an extremely safe return, especially you trading from the comfort of your own home. So that is the second way you could win with this one stock. Now I'm going to go ahead and show you the third way in which you could win. So the third way in which you could win, remember, we did buy a long call for a year out. As the time goes by, that call should appreciate in value. The majority of the time, the stock market does go up. When we bought our call, the share price was around $56. Now, come expiration date, let's say April 17th, if the share price does go all the way up to the strike price we chose right here, once again, we're going to be assigned. This time, assignment means that we're going to lose our long call because we use that as collateral. And now we're going to lose this sell call. So here's what's going to happen. Robinhood is going to buy back this call and they're going to go ahead and sell your leaps option. The net credit you're going to receive, yes, you will be receiving a net credit, is going to be the difference between the strike price you chose of 67.5 and the share price. So that should work out to be around $11. Do not forget, we are trading with options here. So we multiply that $11 by $100, and that's going to give you $1,100. Now, did you recall I did ask you to pay attention to two important numbers? Okay, the first number was the break even. Your break even was around $67. When doing this option strategy, always try your best to choose your strike prices above your break even. Now, the other one I asked you to remember was the delta. The delta in this case is going to act as your percentage gain or loss. It depends on whether the stock appreciates or whether the stock depreciates. So in this case, you're going to take your $1,100 of gain, what you received, you're going to multiply that by 71%, and that is going to be your net gain, providing everything else remains constant. Then you also could add your consistent premium to that, and that is how you use one stock. Two strategies, and there was your three ways to win. So let's go over it one more time. For those of you that have a small account portfolio, this is a perfect way for you to use the 1, 2, 3 method in order for you to grow your portfolio over time consistently. So choose a stock that has all the good fundamentals that you feel good about. Number 2, employ a method of the cash secured put in which you're able to generate consistent income selling puts on that stock. If you are assigned, then you still win because you make consistent income regularly. And also, if you are assigned, then you get the stock at a reduced price. That's your one win. The next strategy you're going to go ahead and use is the PMCC strategy, or poor man's covered call, in which you're going to buy a long call and then you're going to sell consistent covered call. The way you're going to win with that is that you're going to win on the covered call side by getting consistent premium. The other way you're going to win is by stock appreciation, or what I like to call on this channel, investment gains, which is going to be the difference between the strike price you chose and your share price where you bought your leaps option. So this is what I do with my portfolio. This may work for you, it may not work for you. Remember, do your own due diligence before investing. So the 1, 2, 3 method works for me, and I've been using this method consistently in order for me to grow my portfolio safely and consistently over time. Now, go ahead and like the video. Let me know if you guys are going to be employing this option strategy to help you grow your portfolio. Subscribe to the channel. And most importantly, if there's anyone out there struggling to grow a small account portfolio, go ahead and share the video with them. Make sure to hit the notification bell. So this way you're going to receive an alert whenever I post a video. I do post regular, consistent videos. That's one way you can help out the channel. And until the next video, keep pushing your investments.